We welcome you today to the 6th Annual Builder and Development Luncheon. They're going to start serving lunch, and we're going to start a program. My name's Terry Rich. I'm the CEO of the Iowa Lottery. See a lot of familiar faces, both from my hometown, Jefferson, Iowa, actually Cooper right south off the farm down there, and also from around the facilities around here. We've got a lot of folks who have taken risks, made a lot of money, and are looking for the next step, and I think today you're going to hear some very exciting news of what's happening around Iowa and central Iowa. We are really doing well in this state and really well in this community, and I think some exciting times for the builders and developers of our area as we look forward. I think you'll see some stats later today that the People's Company and the folks have put together that you'll really enjoy. So it's fun to be with you, fun to be here. Looks like we've given away our coupons. Let's do our introduction. How about that? We introduce Rachel. I want to say, ladies and gentlemen, it's my honor to introduce today a gentleman who is our main keynote, who I think you'll enjoy, to talk a little about the economy. He's a nationally known acclaimed economist and public speaker, specializing in the minutia of economics, making it fun, relevant, and educational. There was a big land development seminar and session in this room a few weeks ago, and this guy received rave reviews. He's going to talk to us a little bit about all of the things that he sees going on in the economy, very appropriate today. And he also was the senior economist with the National Association of Home Builders in D.C. and obviously a frequent speaker. So we're real proud to have him in Iowa. I think Steve's already sold him a few farms while he's here, but that's part of the deal when you come in to speak at a group like ours, to know the great value of what's going on around here. Ladies and gentlemen, please put your hands together for Mr. Elliot. Elliot Eisenberg.
Thank you.
Nice to have you here.
Thank you very much. It's a pleasure to be here. I'm not sure where to begin. I was here a couple months ago. It's nice to come back. You go someplace once, they hire an economist, it's an accident. They could have hired any economist. You come back a second time, it's like we're going steady now, so I'm feeling the love here. So thank you all for coming. I want to begin. I got lots of comments and lots of things to say, and but I owe you all an apology. The economy fell off a cliff 4.5 years ago now. Maybe you didn't realize it. I'm not sure. You live in Iowa. It's a bit of a bubble here. You kind of missed the worst of it, and you're bouncing along pretty happily. So let me tell you a little story, a self-deprecating one about economics. Can you hear me in the back? Is it working? Good. Yeah, it is? Okay. So these people are in a hot air balloon, and they're lost. They can't figure out where they are. The map says they're over there. They're lost. And they lower the flame on the hot air balloon. The hot air balloon goes down, and they see two people in the crowd down the ground. And they say, "Can you help us? Can you help us?" And the guys in the ground say, "Where are we? Well, can you help? What do you want from us?" And the people in the balloon say, "Hey, we're lost. Can you tell us where we are?" And the people in the ground say, "You're 427 feet up in the sky in a blue hot air balloon." And the people in the basket in the hot air balloon who are lost say, "Of course, our luck, we found two economists." Economists are famous for giving you information that's really accurate, like federal funds rates are determined the third Tuesday of the month at 10 o'clock or something like that, but use information that's not useful. What I'm going to try and do today here is explain to you why I think the market's recovering, and why I think in particular the housing market's recovering. The overall economy is doing okay, but now housing's actually going to be leading the economy as opposed to being a drag on the economy like it's been for the last 5 or 6 years. So without further ado, let me begin. Let's sort of walk through it. I'm going to start out with a fun top 10 list that makes economics almost entertaining. I know I'm not Dave Letterman, but we all have our delusions of adequacy, right? All right, so here goes. 10 things why things are getting better. First, factory utilization rates are almost back up to where they belong. In the pit of the recession, we'll have a slide, they fell to about 65%. Right now, they're about 79. I'd like to see them get to 80 or 81 or 82%. But that means we're going to have to start building plant and equipment in the not too distant future to get more productivity, more stuff being made, more stuff being built. Right, Art? Now, the next thing that's going on is interest rates. Interest rates are going nowhere. For the foreseeable future, especially now because of sequestration, we're going to have pretty crummy economic data for the first couple of quarters of 2013. Even if they end up changing the sequestration somehow and giving the agencies more control over how their budgets are spent, which will probably happen at the end of the month, and we can get into that a little later on. But GDP numbers are going to be crummy. We're going to have the Fed's going to keep buying $85 billion a month in treasuries and mortgage-backed securities longer than they had planned, in part because of the rotten sequestration. So the bad news, sequestration lowers GDP. The good news, sequestration causes interest rates to remain lower longer because of the crappy GDP. 8, corporate sector's rocking. Not every company, but so many corporations now are doing spectacularly well. The U.S. is now really lean and really mean. Unit costs and labor side are very low. In part, wages haven't done terribly well for macro factors, and productivity increases due to technological improvements and supply chain management and tough arming suppliers and those guys. American factories are as competitive as they have ever been. Unit costs now are, in many cases on the manufacturing side, lower than they were 20 or even 25 years ago in some cases. And that's why you see companies now actually onshoring work, bringing it back from Asia because they're cost competitive here because of the tremendous productivity increases that have happened. 7, consumer sentiment, or sentiment as I say, is better. They came out with new numbers today. They're not in my slides. We'll discuss some numbers there. It's pretty good. It's not great by any stretch of the imagination, but it's gotten better. And it continues to generally improve. It may go down now because of the sequestration and the tax increases that we've experienced, Social Security taxes that went up in January. There are some headwinds out there and crummy GDP numbers. But among people who have their jobs, they're going to be okay. This furlough is not going to be the end of the world. Some people will lose their jobs or a furlough for a month or a week or whatever. It's not going to cause wild damage to consumer sentiment. Not wild damage, a little bit maybe. 6, the Europeans can't stay dumb forever. Maybe they'll get smart. And then I say, well, actually, maybe not. European problems aren't over. This is one of the flies in the ointment going forward here in the States. Our exports to Europe and this continual spasms of problems the Europeans face, the Europeans really haven't dealt with the total cost of their problem. In America here, we recapitalized our banks, and we've delevered on a household size. Households have delevered. There's been a tremendous amount of progress in cleaning up the mess that resulted from the collapse in the economy 4.5 years ago. The Europeans aren't there. They aren't there for a couple reasons. The most important one is it takes them 17 governments have to agree to tie their shoelaces in Europe. Here it's hard enough with 2 parties and 1 Congress to get things done. Imagine having 17 parties of equal size in Congress. And I understand why they're failing, but the fact is they're not doing well. And there'll be probably another shoe to drop somewhere in Europe. I'm not sure when, I'm not sure how, but there'll be problems. And now we have our own Congress, but nonetheless, Congress here in the States, despite being as insanely nuts as they are, they have actually made some real fiscal accomplishments, which we'll discuss later. That's a good thing in the long run. 5, the rich are doing well. So Steve, where are you? Let's make sure to sell some farms to some rich people, okay? Rich people, focus on them. 4, housing is doing, relatively speaking, spectacularly well. Not well, but spectacularly well compared to where it's been. In 07, 8, 9, 10, and 11, and the first half of 12 even, housing detracted from GDP continually. 0.5 point, 1/4 point, 3/4 of a point. But now housing is going to be contributing to GDP going forward. And if you look at economic leading indicators, home construction activity and construction activity in general is a very good leading economic indicator. One of the best, if not the best. So this suggests that the economy will do pretty well because housing is doing well. And we'll get some data, lots of data on that. I'll explain to you why I'm so bullish on housing. 3, state and local governments are on the mend. For a long time, they were firing people on a regular basis, 10, 15, 20,000 a month. That's largely over. So we're not going to see a fiscal drag and a headwind coming from state and local governments so much. Also a good thing. A couple more. Household formations up. This gets back to the real estate business and single-fam construction, multi-fam construction. You need household formation, and the reason household formation's up is because jobs are up. Jobs are we're creating net new jobs every month. Not as many as we'd like, and we'll get into some details there too. But we're creating jobs. People are moving out of their parents' basement and buying a house, renting an apartment, whatever it is. This is a good sign. Second to last reason here, no more countries left to go into recession. You know, all of Europe's in a recession. Japan's been in a recession forever. China's slowing down. Canada's slowing down. Despite this, we're doing okay. So imagine when these countries actually get out of the can and start performing like they can, and we can export more to these foreign countries. This is hurting us in that respect, but it will eventually get better. They will not be there forever. Every country isn't Japan, all right? So we're optimistic there. And lastly, because I say so. So there's a lot of things going on here that are pretty optimistic and pretty good. Let's go into some details here. First, this is the only bad slide I will show you. What's going on here is we compare the current recession, the big fat red line, to all the other post-World War II recessions. So get out of your mind the notion that this recession is similar. It's not. It has nothing to do with any recession you've ever experienced in your life unless you're about 100 years old. And you remember the recession of 1929, or the depression of 29, followed by the 32 and 33 and so on. This is fundamentally different. Therefore, everything you think about recessions, just tip it out of your head. It's not going to help you figure out what's going on and how things are improving and why they're taking longer and so on. Now, historical job growth, last 30 years of job growth here, since 79, not quite 30 years. You can see what's going on here. During the Clinton administration, during Reagan, this was job growth, above 2.5% per month, essentially year over year. Under Clinton, it was about 2.5. Under Bush, it was about 2, and now it's even more anemic. There's been a slow and steady decline in job growth. I'm not sure if it's going to persist, but it certainly makes me slightly nervous. So do I see job growth continuing to do okay? Yeah, 160, 170, 180, maybe 190,000 jobs a month this year. Certainly better than last year's 170, year before 150. But I don't see 300 or these huge numbers that we had way back when in the 70s and 80s, and even during Clinton in the 90s. Next, this is causing unemployment rates to come down seemingly slowly. We talk about the slow rate of improvement in unemployment. It's not that slow, actually. I don't understand this. Look, it took a long time there. It took a long time here. There it happened very fast. So what happened was this was considered the first jobless recovery. It took a long, this is the second jobless recovery. Now we're on the third jobless recovery. It's as if our economy changed. Somewhere here, recessions took longer to recover from. 2, 3 years, 3 years, now it's maybe 4 or 5 or even 7 years to get employment back to where it was. There's been some fundamental change in our economy. We can talk about it later, bug me afterwards. But it's not going to be fast. Now, there are some mitigating circumstances here on employment that are important. First, U.S. labor productivity is no longer going up. The first couple quarters after the recession, you can see huge labor productivity gains, which is typical after a recession. But now they're over. So if companies want to get more stuff done, they're going to have to hire people. And if they're going to hire people, they're going to have to build factories. This is the factory utilization rate. And we'd like it to be in the low 80s. It's now almost there. This is the latest data. It's a couple months behind, but it's the best there is. It keeps going up. So they're going to have to hire people, and they're going to have to build plant and equipment to make the stuff that we're going to want. So this is setting the table up for improvement as we go forward. Next, this is a problem. Real personal capital disposable income has been going nowhere for a good long time. And the problem is exacerbated by the fact that we're still 3 million jobs behind where we were 5 years ago. So real incomes aren't going up, and total employment is lower than it was. And this is why GDP has been sluggish. It's because households don't have a lot of money. The rich who are buying farms from you, Steve, are doing well, because they have money. They're not median people, and they have lots of dividend and interest income. Okay, not much interest income nowadays, but certainly dividend income. So, but the average Joe looking to buy a house or buy a piece of land is having more trouble. This is a secular problem. It's not going to go away. It wasn't created in the past recession. It's been going on for roughly 30 years already. So, but keeping this in mind as you go forward, GDP growth going forward is going to be relatively anemic. This is 50 years of GDP growth. And it's slowly come down, but the key thing is to focus in the last 10 years or so. So here under Clinton, we had pretty good GDP growth, 3.5%. Under Reagan, we had also pretty good GDP growth. Under Bush, it was more anemic, and under Obama, it's been even more anemic. I'm not suggesting the presidents are to blame or to get credit. It's just to keep in mind markers of where we are. So what's going to happen now is Q4, they just revised up to 0.1 of a point. This coming quarter will be maybe 1% because of the headwinds of sequestration. Maybe Q2 gets us to 1.5. Maybe by the end of the year, if things go right and we're lucky and we all pray properly, we hit 2.5%. And we've cleaned away the sequestration problems and the Social Security tax increase problems. But it's certainly going to take its toll in Q1 and Q2 for sure this year. They will be somewhat weaker. It's inevitable. Savings rates, today they showed data, income numbers went down, savings numbers went down. This is a little unsustainable, so there's going to have to be some slowdown in spending somewhere. And we know, when we talked about the rich doing well, we know the poor aren't doing that well.
And we know that from the Walmart data. Walmart came out with data last week. They are the perfect customers to look at that information. They're the folks having the hardest time. They're the ones suffering the most when gas prices go up, when Social Security taxes go up. They're the ones who, that $100 a week or $100 every 2 weeks really makes a big difference to them, and that's being reflected in the Walmart sales. Not so much in Louis Vuitton sales. They're doing okay, you know? And Van Cleef and Arpels jewelry, they're doing okay too. But at the lower end shops, they're having a harder time. Now, what's driving the economy? Housing sales, car sales are stupendously good. They've rebounded dramatically from the low point in the recession of about 8 million, 9 million units. They're now at 15.5 million units. Car sales data is coming out today, and a couple car makers already released their data, and it was pretty good. It wasn't spectacular, but we're still at this 15.5 million units. You need to have cars, which are doing great. You need to have houses to do well, because when the economy improves, it's these sectors that are profoundly dependent upon credit that pull the economy out of the recession. And if you don't have these guys going, you can't get moving all by yourself. You need credit extension, and these are the places where households get credit. So you need them. Container traffic has recovered 2012, the black line on top. It's looking good. It's fully recovered, as has the Architectural American Institute of Architects numbers have also virtually gotten back to where they were. This is also an excellent 12-month leading indicator. So I expect there's residential construction doing well, and this is all types of construction, residential, commercial, industrial, public, all kinds, you know, private sector, whatever, all kinds of stuff. This is a good piece of news. More good news, non-manufacturing numbers are pretty good also. They're not bad. This is services, you know, healthcare, education, all those things keep chugging along. So you've got housing finally working, you got automobiles doing well, you've got services doing okay, retail sales are doing very pleasantly as well. They fully recovered also. Natural gas, I'm not going to get into it a lot in this slide, but suffice it to say natural gas and oil discoveries in America are going to transform our economy in the long run. Not so much today or tomorrow, but over the long period of time, there's a lot of benefit there. Companies that need electricity, need energy to do whatever they make are going to want to move here from Europe, from Japan, because we're an industrialized country, we have the rule of law, we have ample supplies of energy, and we're a stable democracy. There aren't a lot of places that can say that. Most energy being discovered today is in really bad locations like Venezuela and, you know, Nigeria and so on and so forth. This is a huge boon for us down the road. Corporate profits, as I talked about earlier, are doing spectacularly well. GDP, since the pit of the recession, has gone up by about 7%, maybe 8%. It hasn't been great, but look at corporate profits. Before the recession, they were there at about 1.3 trillion bucks. Now they're about 1.7 trillion. They went up by 25, 30% on a trivial increase in GDP. So the corporate profits that are driving, in part, the stock market, it's not because of top line, it's not because of sales are going up, it's because the internal organization of the firm has gotten much better. This means corporations have tons of money. One of these days, they're going to decide to spend it. When, I don't know, but this is like having something an ace in your pocket that at some point you're going to want to pull out. So this is good news, and it also means, I mentioned earlier, the onshoring of jobs that will come, and that will spur increased demand and so on and so forth. This is a terrific thing. Now, inflation's a big bugaboo. People all are concerned about inflation. You're concerned about inflation because of this slide. The Federal Reserve's balance sheet used to be about 800 billion bucks. That's right there. It went up over decades to 800 billion. Now it's at 3 trillion or 3.1, and by the end of the year, it'll be up there around 4 trillion bucks. This massive growth in the money supply seemingly has to cause inflation. But it hasn't. Why hasn't it caused inflation? Look at the next slide. Monetary velocity's fallen like a rock. People just take the money and they save it. They take the money and they buy something and then the bank saves it. Or they get money they earn and they buy a bond. But they're not spending it. They're not getting Rogaine treatments. Okay? We've got to spend this money to get the economy moving. So the Fed's flooding the economy with money, And banks in general are reluctant to lend. You can blame the bank, you can blame regulators, you can blame the quality of the borrower, you can blame Dodd-Frank. I mean, we can go around and have a circular suicide, a shooting match or something. But the problem is we're not using the money. And as long as the money is not getting used, there's no fear of inflation. So you could say, thank God the banks aren't lending. That's why there's no inflation. Now, when they start, velocity will rise and inflation will come out of the bag. But it won't because the Fed will take care of it, I think, but we can argue about that. Next, another example of why there's no inflation. The money multiplier has fallen below 1. This is unbelievable. This is sort of a miraculous event that I thought when I was in graduate school and learning about monetary theory, you couldn't have such a thing. This is impossible. This is like putting $1 in and only having 95 cents of economic activity. It couldn't be. I would have bet my life you couldn't even have this below 1 thing, but we are. Again, it coincides with a drop in monetary velocity, and there are lots of other slides showing this. Here's one more. Inflation numbers. This is the personal consumption expenditure data numbers, which is the Federal Reserve uses as their measure of inflation. Look, there's no inflation. There's no inflation. This is 2% line. The blue is with gasoline and energy and food. The red line is without energy and food. There's no inflation right now. That's when the Fed can keep spending money and printing money without fear of inflation. Now, when the banks start to lend, they're going to have to withdraw the money. They'll screw up. They'll be late. We'll get some inflation. They'll do it early. We'll have a GDP decline or maybe a mild recession. But the Fed's thinking carefully about how to deal with this problem. They're humans and they're fallible and they'll get it wrong, of course. But there's no evidence anywhere of wage inflation or systematic cost inflation. Sure, lumber prices are higher or sheetrock or something. Anywhere there's cement prices or things, yeah. And oil gas prices go up and down like a yo-yo with no historic behavior. But there's no systemic inflation here. There's some commodity inflation, sure. But as far as the Fed's concerned, they got no problem, so they'll continue doing what they're doing for the foreseeable future. I'm sure for 9 or 10 more months, we will continue having massive quantitative easing at the Fed level, which means we're going to have low interest rates. They're not going to get any lower. This is the end of the road on interest rates. We've had a 30-year run thanks to Paul Volcker back in the early 80s. It's over. They're going to go up. But don't worry. The Fed's going to try. They may fail, but they're going to try to have the economy the good economy will pull interest rates with it. They don't want to kill the recovery by raising rates too quickly. This is the key dance they're going to try to do. By telling investors, relax. We're going to let the economy go. We're going to let GDP growth get good, and then we'll start raising rates. They want us to understand that's what they're going to do, because if we believe that will happen, then it will happen. If we're convinced they'll raise rates early, before the economy can take it, we'll have a recession or go into the can. They don't want that to happen. Whether they'll be successful or not remains to be seen, but that's the process they're going to try and create. Now, on the real economy in terms of the budget situation, things are substantially better. If you go back to summer of 2011, a year and a half ago, Boehner and Obama go golfing. They talk about the grand bargain at the time. The grand bargain was a $4 trillion deal. Entitlements, this, inflation, cost of living adjustments, defense spending, social spending. We'll put it all in a pot. We'll have tax reform, $4 trillion over a decade. That's how much money we needed to fix to get our deficit problem under control and reduce the rate of growth in our public debt. The deal fell apart. They never had it. They did have some mild tax increases in March of 11. They then had some more tax increases at that time in the summer of 11, when our credit rating went down and the government almost didn't pay its bills. We had some more tax increases and spending cuts in December 31st, Jan 1 at the fiscal cliff deal. And now we have another $1 trillion of spending cuts because of sequestration. If you add that up together, you've got roughly $3.5 trillion in spending cuts and tax increases. It's not $4 billion, but it's close. So part of me, despite the fact that I don't want to see the sequester happen now because the economy is not quite strong enough to withstand it, says, hey, it's $1 trillion. And we need to get this spending down. And if we're going to do it, let's already do it. We're already there. Let's just get on with the show so we can swallow hard, lie in bed for a couple days, get better, and by fall or winter we'll be recovered. So there's a little more tax increases or spending cuts that have to come down the road to stabilize GDP, deficit over GDP ratio, get it down to like 3%. But we're close. We're close at stabilizing our debt to GDP, total debt to GDP, at about 77, 70 on the public debt side. That's not, I'd like it to be lower, but we're almost there. So Congress is lurching forward. This is also good news. Consumer confidence is getting better, not great, getting better. What else we got here? Small business confidence, getting better, not great, getting better. There's almost no places where things are getting worse. Exports, here's some production. This is not so great numbers. You'd like it to be up here. It's down here. This is not great. This is a sign of exports and manufacturing. Here too, right after the recession, exports and manufacturing were awesome. Now they're ticking up a little bit again, but they're not where they were. We'd like to see them get better, but they're a victim of foreign demand, and demand's not there because the rest of the world's not doing as well as we'd like it to do, and is generally not doing as well as we are, at least in the Western democracies. So exports are hurting. Now, let's talk about housing. Housing is doing well. It's cleaned itself up nationally. The problems that were there and were pervasive are melting away one by one. Not magically, because of the miserable experiences we've had in price declines and so on. So first things first, household formations, the single most important piece of data. It's generated because of net new jobs we're getting of 170, 180,000 a month. What's happening is people are finally moving out of their parents' basement. So Jeff, you're married, you and your wife live with your mother-in-law, right? You're unemployed, you have plenty of time. It turns out even in your spare time, you don't do much nookie. You know why? They used to have this data on fertility rates. I'm going to digress just for a minute here and titillate the public here. I would have thought kind of fertility rates might actually increase during recessions because you have free time on your hands and you have no money, right? It turns out no. It turns out, you know why it's no? Because I guess your wife or your girlfriend says, Jeff, while he's getting amorous, and he's getting excited here, his wife says, Jeff, shh, not now. Mommy's upstairs. I guess it's a bit of a buzzkill, I don't know. But anyways, that's what you get. That having been said, household formation is improving because jobs are getting better. People are moving out. They're renting apartments, buying condos, buying garden apartments, buying single-family detached houses and stuff like that. This is the key driver. It's the key driver. And if you see how high it was in the early prior years, it was pretty good at 1.1, 1.2 million a year. And then it collapses overnight to 500,000. This is a staggering decline because there's no jobs. We're creating no new jobs, and we've lost 8 million, 7 million jobs from peak to trough. From the end of 07 to the middle of 09, we lost 8 million jobs. We're still only 2/3 of the way there recovering those jobs back. But we're starting to, and therefore people are moving out of their parents' house, and we're buying houses. So this is the key number for housing sector specifically. Historically, house prices are about 3.23 times income. So you make average income $100,000 in the community, average house price $300,000. And somehow we watched this piece of data go whoosh. What were we thinking? I mean, really? Really? Do you think this is sustainable? Now in retrospect, it's obvious that we were heading to a calamitous decline in house prices because unless I could sell my daughter or have her a 3-income family, me and my ex-wife, I'm joking, my wife, and then my daughter, I mean, what's she going to do? What's she going to make? Make paper airplanes or something? I mean, how can you have house prices nationally go up by 50% essentially with incomes going nowhere so that the cost of the house is now 50% more than it was? This is not a sustainable model. It cannot stay, and when things are unsustainable, they stop. Because it stopped and the prices came down dramatically, we've begun to clean the mess up. That's the key. So let's watch. We had price declines that brought it from 4.7 back down to 3, and that's the price decline. Look at this huge ski slope. This is dangerous on the up and dangerous on the way down, and it's, so now we see prices literally going up, up, up. You don't need a PhD to figure this stuff out. This is up, this is up. That's down, this is up. Up, down. Practice at night. Think about it. Up, down. So we're getting better. This is house price to rent ratios, and they're now back to where they were. Let's look at nominal house prices. Nominal house prices are up, and look what happens. The price declines have brought us back to roughly 03, 04. That's on the nominal side. If you look at real prices, it's worse. back to 2000. So we've destroyed 13 years of house price growth. If you tell me we have to go through more of this, I don't think so. We've brought the ratio of house price to income back to 3, where it belongs, because we've suffered this incredibly staggering decline in average house price. But it's over. It doesn't mean people are underwater. Lots of folks are underwater, and lots of folks are miserable, and lots of folks are going to default on their homes. But part of the problem is done. This is finished. House prices aren't going to decline anymore. Here's another example of changes. If the lines are above the horizontal axis, it's good. See? They're up. That's up. That's down. Got it? Another example of how, as long as the house price is above the dark blue-black line, it's good. This is not seasonally adjusted. What this means is house prices have a cycle. They go up in spring and summer, down in fall and winter. Up in spring and summer, down in fall and winter. But the last couple years, the peak is getting better. The trough is getting better. House prices are, no matter how you measure it, which index you look at, NAR, Federal Housing Finance Agency, Case-Shiller, CoreLogic, RealtyTrack, I don't care which one you use, seasonally adjusted, if it's historical pairwise comparison, you can use any econometrics you want. The data is plainly clear. Now, as a result of house prices going up, negative equity is going down. Negative equity has a cycle too. It gets bad in winter, good in summer. Bad in winter, good in summer. So you have this cyclical thing, but there's a trend. Look, it's continually getting better because house prices are going up, and as house prices go up, fewer people are in negative equity. Doesn't mean the problem's going away. This is still a staggeringly large problem, but it's substantially less than it was. 17 million versus 10 million, a lot better. 2 or 3 more years, and we'll probably get rid of this, and we'll talk about that a little more. Next, delinquent loans are trending down. Are they there yet? No, but they're making progress because we're slowly cleaning it up. HARP is helping federal program. HAMP is helping another federal program. Banks are letting short sales occur, and so on and so forth. Also good stuff. The real estate owned inventory, this is for banks, it's going down. Is it too high? Yeah. Is it better than it was? You better believe it. So again, a sign of improvement. It's not a sign of fantasticness, no such word, but you get the point. It's way better. We've been through the worst. It's kind of like we were like meth addicts. This is the Midwest. Yeah, meth is popular here. Okay, so we're taking meth, and we realize, maybe it's time to kick the habit. So we go into detox or readaptation, and you go to some clinic, right? And they have nice music, and they basically starve you to death, or I don't know what they do to you. It sounds bad. Maybe you get methadone or something. I don't know. Anyways, I don't talk from personal experience. Anyways, you go to these clinics. As you're there, things get better, and then you leave a month or 2 later clean. That's what's going on now. You went on a binge, you drank yourself silly, you go home, you have a hangover. But after a couple days, you have a long binge, a long weekend, you fix yourself up, and by Tuesday or Wednesday, if you're still employed, you got a job and things are getting better. That's what we're going through here. This was the partying, so to speak. It was actually back here. And this is the getting better. This is getting in the clinic and getting detoxed. Here's another measure of improvement. Bank write-offs of residential loans. They're going down. It isn't like they're low where they were. I mean, look at that. That's history. That's where we are now. That's a far cry, but it's also a far cry from the peak of the problem. It's because these bad housing problems are being worked out. That's the key point. It takes time. It's been 4 or 5 years, but we're getting there. We're making real progress. Another sign, home inventories are way down. This is spec homes built for sale, not sold. These are homes being built for sale, not sold, and these are permits, not even built. Look at this. This is a sign of massive insanity. This is builders shooting themselves in the head, building stupid homes for nobody, okay? But they learned, and they learned, and they learned. You see this, whenever you see things going up vertically, pray, because you know something bad's going to happen. Stock market, whatever it is, when things go like this means the end is near in some shape, way, or form. I've learned this from years of economics. This is a key piece of lesson. Normal curves go like this. When they go like this, start selling short in a hurry, okay? That's the key here. That's the takeaway message. So we've cleaned up another measure of how builders aren't building houses because they know they had too many, so they've cleaned up, they've reduced construction activity, and now we're beginning to increase it again. Household formation's up. We need more houses. There are more people. We're creating jobs. And this number will start to tick up now. But we're cleaning it up. Inventories are way, way, way down. They may go up in the summer now as house prices go up. People who are upside down may sell their houses, in fact. But look at where we've been. We were way up here. This is unbelievable territory. This is a nightmare. And we've come down. This is federal government intervention. Drastic reduction. We're too low now because we're cleaning it up. There may be more spasms going forward, but we're cleaning it up. The message here is things are getting better. They really, across the board. Existing home inventory is getting better too for the same reason. Houses are getting cleaned up. There's some problems here which we'll discuss shortly, but mortgage applications in general are going up. Not as fast as they went down, and not in the good old days. That was the best. You look at that and you think about it and you get excited and you almost want a cigarette. It's like, man, you know, every time I give this slide, you want to touch it and relive those good glory days. This is kind of like those old music commercials, you know, live back in the 50s and hear the Vince Everly Band or something, you know, and you think back to your youth when things were wonderful. This was like, you know, everybody was rich and making tons of money. Every business decision was a success. You thought you were a genius until it all went to hell in a handbasket. It's going to get better. It is getting better. People are buying houses. They're renting apartments. It's not perfect. It's getting better. Here, now there's another whole theme here of households fixing up their balance sheets. The federal government, as I told you earlier, is fixing up its balance sheet with tax increases and spending cuts totaling roughly $3.5 trillion if we stick with the sequester. Corporations are in fabulous shape and their balance sheets are rock solid. Not every company, but many companies. And households are doing the same thing. This is refi activity. The red tells you you're refining to a shorter term, from a 30 to a 15, from a 20 to a 10, and so on. Blue says you're refining to a longer term, from 15 to 30. So in the height of the housing miasma, we were all refining from 15 to 30s. Now we're all refining from 30s to 15s. The housing market's recovering because households themselves are recovering. Next, household financial obligations have dropped like a rock. Look at this. Free cash flow essentially has gone up because the obligations went from 19% of disposable income down to about 15.5. A huge decline in a short period of time. Households have charged off, defaulted on debt, done all kinds of stuff, paid down debt, increased savings, refied their houses, taken advantage of low rates, and so on. But the combination of low rates and refi on one hand, and defaults and foreclosure and releasing debt on the other has caused this to happen. So even though disposable income hasn't really gone up, top line disposable, we know they have more discretionary income because they have less debt obligations now. This may change with school debt and so on, which are really problematic, but I'm not going to go there today. Another measure of our success, and this is maybe the most painful on the household side, is deleveraging. Look at this. Look at that line. That's 60 years of data. Do you see anywhere that line declining? Never. In recessions in the past, you saw maybe a horizontal line for a little while, but never did it go down, except now. This is a magnitude of the severity of the recession we experienced, and this is showing you in large measure why it's taken so long to get out of the ditch, because households are borrowing in total less. And when you borrow less, you buy less, and you borrow, you have these things, you can borrow $10,000, $20,000, buy a car. Well, maybe I won't. I'll do this, maybe I won't. I'll buy a TV, maybe I won't. I'll get my teeth done. I'll get my hair done, maybe I won't. I'll buy a fancy handbag, I won't. I'll buy a suit, I won't. I won't. This is such a huge thing, and this has happened very quickly. And because it's happened so quickly, this number has fallen so fast. These are very important fundamental adjustments our economy has made to get our economy rolling. And that's why our economic GDP growth has been so anemic, because these underlying factors have been slowly getting cleaned up. And now we're kind of getting ready to do okay after the sequestration and the Social Security tax increases and so on. Wealth. Look at the wealth numbers. They're almost back to where they were. They fell by about $16 trillion from peak to trough. You know, from peak over here to trough over there, but they're almost back. And the next number, which comes out quarterly, will probably show it back up because the stock market's now doing very well. So income, wealth, total wealth is back up. So among the wealthier half of the population, things are going pretty good. The bottom half is having a hard time at Walmart, but the other half's doing okay as measured by here. This is also another measure of improvement. Households, more, savings rates. They actually went up last quarter before last to 6. Now they just collapsed to 2.5. Today, this data came out because of last quarter was higher because dividends were really big and people saved the money. Now the dividends stopped and incomes are lower because of the Social Security tax increase. Savings went down. But nonetheless, it's still around here is better than it was here in the boom, the real estate boom. So we've become a little more conservative and a little better behaved, a little less reckless. This is okay. This is housing starts in blue. Housing starts are getting better. The home builders are feeling more enthusiastic, maybe a little too enthusiastic, but even when the red line gets ahead of the blue line, like it did here and here and here, it doesn't portend a massive decline in housing starts. It just means the builders are getting a little bit too enthusiastic and they're doing too much meth on the weekends or something. And the reason it didn't go crazy over here and the red didn't get above the blue right there is because the banks were doing the meth with the builders, and the assessors were doing the meth with the builders, and the appraisers were doing the meth with the builders, and the developers were doing the meth with the builders, okay? They were all doing meth at the same time in the jacuzzi. But normally builder sentiment goes way up when things get better, and then it comes down to reality. This will happen here as well, but it doesn't mean housing starts will go down. It means the blue will keep going up and the red will come down. Now, big trend change, big important trend change, renter versus owner. We're changing. I'm not sure this is a permanent change. I really don't think it is a permanent change, but we do know that in the years 2000 through 2005, ownership was cool and being a renter meant being a loser. Only losers rented. Everyone could get a loan. Right? Banks gave you no job, no income, no anything, no problem. Here's a loan anyways. We'll give you 110% because we trust you. Things changed dramatically last half a decade. All rent, no own. Home ownership rates have collapsed as a result. Absolutely collapsed from 69 to here, 65.5. And I think the real number's actually there because these two dots are below the blue line. These are much more trustworthy census data numbers. These are from surveys. I don't trust them. They're biased up. So I think the home ownership rates are actually around 64% right now. And it may fall a little more before we're done. That's just the way it is. You have no income, you have no FICO score, you have no down payment, your parents can't give you a down payment, your children can't give you a down payment, you can't buy a house. That's all it tells you. So we're going to have to rent now. So think about rentership, and how to accommodate that change in the population. It's not the whole population. This is just 4 or 5%. That means 6-7 million households. But it's nonetheless a significant chunk, and it changed. I think it's temporary again, but it's a change. So we look at multifamily housing starts because of the massive decline in home ownership. It's fed this tremendous increase in multifamily activity. Had someone asked me 3 years ago when we were here, would multifam have recovered to its normal historical level in 3 years, I would have said you're out of your mind. I was totally wrong. Because of the severity of the decline and the loss of wealth, people had to rent. And that's what you're seeing in that line right there, is massive amounts of construction in multifam. So if you have some land, build a multifam unit quickly, rent it up, and then sell it to a foreign company like Japan, where they're stupid enough to invest and buy it, you know. They bought our mortgages a couple of years ago. This is a much better investment. They'll be happy to buy it. But this process may be coming to an end. I think we're not going to see going up here. That's not happening. I mean, we may get to here, but I think we're going to start slowing down, and the boom is probably off. The blooming boom is off the road. Look here. This is 2 to 4 unit activity, deader than a doornail nationally. And it wasn't big to begin with. You only had 40,000, so you only had 10 or 15% of multifam structures were 2 to 4 units. But it's totally collapsed. There's no interest in this at all. None, zero. This is like townhouses, not so popular, nationally anyways. All right. Now, why do I think the golden age of multifam, huge increases in profits, low cap, good multiples? It's because of this index. I'm not an expert in the index. This is National Multi-Housing Council. Look, it went down. It went down before. It came down again. Maybe there's something here. I'm not sure. But it doesn't mean multifam's bad. It means it's not quite as good as it was, right? Now, let's talk about the future. What's going to happen to housing going forward? I think housing's got a good run. I really do. Because normally, residential fixed investment as a percentage of GDP is about 5 or 5.5%, right here, 5.5, right there, okay? And then it goes up a bit, and then it crashes down. It's got to go back up again. We can argue whether it be 4.5, 4 3/4, maybe even 5% eventually. But it's now way down here. To get from there to here will take time. It isn't going to happen in a weekend. It will take several years for this process to occur. So we can see housing activity increasing by 20% in 13, by 20% in 14, probably by 20% in 15, and it wouldn't surprise you if you got 10 or 15% in 16, and then we're kind of done. And this year we'll have multifamily activity also at the 15 to 20% range, and I think after that multifamily growth is largely done, and then it'll be mostly single family telling the story at that point. As balance sheets continue to improve, people buy houses and so on and so forth. This process has staying power because it's so low. Now, it also has staying power because loan officers are finally deciding to lend a little bit. When the numbers go up, it means you can't get a loan. This makes loans getting harder and harder and harder to get. And slowly, it's gotten a little better. It ain't great, but it's better. Remember, this is just 07. This is not 2004, 2003. The data doesn't go back far enough to show that. But this is still a relatively hard time to get a loan because the economy was already falling off a cliff at this point, okay? But it's getting better. So as it gets better and banks understand Dodd-Frank better and people's financial situations improve and bankers are more comfortable lending, things will improve a little more. So there's some more gas in the tank, if you will. The gas, there's more gas here to pour on the household stimulative activity of the economy. Now, the big fly in the ointment, not Iowa, is judicial versus non-judicial state. This means when you foreclose on your house in a judicial state, like Florida or New York, you can live in your house for like 27 years before they finally evict you, right? So Danielle here lives in a house, and she says, I don't want to pay my mortgage, I'm tired. And you live in New Jersey, luckily, so you live like for 14 years, and you pay no interest, and you pay nothing, and you get the house for free. They turf you out finally. But in normal states, there are 30 states that are normal, only 20 that have this weird judicial problem. There, the problems are much better. So if you look at the data here, you see in non-judicial states like Iowa, the severity of the default foreclosure problems peaked back here in Q4 09 and have been slowly and steadily declining. By contrast, in judicial states, where Danielle lives, right, the problem kept getting worse and worse and worse until it finally peaks out just recently, a couple quarters ago, and now is beginning to go down. This is going to cause delay in home improvement in all those judicial states. So if you have business in judicial states, take it easy, take a breather, work in the non-judicial states for a while. Let that problem simmer and work its way through the system. Let's look about what's going on here now in Iowa. You're a happy place. I can't remember the quote very well exactly. It's from Anton Chekhov, a great Russian playwright. And he said something like, in one of his plays, he said something like, all happy families are the same, but all unhappy families are miserable in their own unique way. You're a happy family here. It's not worth spending a lot of time, relatively speaking. We'll spend some, but you are good. You missed the bubble on the up. Your foreclosure problems are tiny by comparison to the bad states. You aren't a judicial state. You have ag that's running on all cylinders. You got a big, humongous research university 35 miles away. You're the state capital. You've got the financial institutions, principal and so on, and the insurance industry banging away happily and doing well. You have a diversified economy with every single sector doing well. So you should be doing well. Give yourself a hand, be appreciative of where you are, and fight off. And people will start, if you're careful, you might actually get some immigration here. I know you don't want that, I'm kidding. But people say, wow, this is a great place to live. I mean, like North Dakota now is like a job magnet, right? So, as someone said to me, I said, you don't have energy here. And they said, yeah, not yet. But you'll find, if you're lucky, you'll find some fracking activity, you'll find some oil wells somewhere in Waterloo or something. I'm making this up, but you get the idea. And that'll be even better. So you've got a good thing going. There's nothing fundamentally wrong with your economy here. Diversification, good growth. You missed the bus. Your domestic, your community banks are in pretty good shape, or very good shape. So this is what's the coincident indicators put out by the Federal Reserve Board of Philadelphia. I'm not sure you know where your state is, but if you aren't sure, it's right there. And you're doing okay. You're sort of in the middle. This is good. This is terrible. That's outstanding. This is good. You're a little better than average. Average is gray. You're better than gray, and you're like the most of the other rest of the country. Things are pretty good right now. This is going forward 6 months, and you're a shade darker, meaning you're a shade better. So now you've gone from here, you've gone from, now you're here. This is really good. The Midwest is all a very happy place. Except for Indiana, Michigan, the rest is a pretty happy place. You've overcome the problems. Unemployment in Ohio is coming down. All these places are now improving because automobiles are doing well. Manufactured housing is doing well. Exports not as well as they were 2 years ago, but still doing okay. So you've got the forward-looking indicators are also pretty decent. He's so excited he's leaving to take advantage of the good news. Bye, Dorrance. It's been a pleasure. You're on my list, buddy. Okay. The number of mortgages you have that are underwater is pretty low. It could be lower, but not a lot. Come on. These are states here where it's super low. North Dakota has energy. West Virginia has energy. New York, half New York didn't experience a decline. Montana has energy. Maine, no one lives there. Hawaii, who cares? It's all rich tourists, and now it's Chinese people. Texas didn't have a problem because they didn't let you overborrow. There's a constitutional law that prevented you from doing it. So almost every state below you had some weird story going on. But you're in this very low end. I mean, you aren't even in the middle. You're way down. Very good situation. This is really nice. This is exciting. It's fun to touch this. Again, defaults, delinquencies sorted by 30, 60, 90 days. Again, very low. It isn't even this number is higher than it was. North Dakota, again, the best state in the union, is higher than it was 5, 8, 9 years ago in the boom, right? 4, 5, and 6. It's still higher than it was then. But again, you're in this bottom 10%. This is good. You're okay. You have, again, you're firing on all cylinders. Ag is good. Education's good. Healthcare is good. Insurance industry is good. There's no fundamental problem, as you can see here. This is an interesting slide. This is the judicial, non-judicial issue that I talked about earlier. The dark-colored states are judicial states. They have lots of problems. They're far to the left, your left, right? The non-judicial states are to the right with almost no exceptions. There's 1 or 2 exceptions here, and there are 3 exceptions here. But they're basically bad states are judicial because the problems persist, and they will continue to persist for a while. These states, by contrast, are in great shape. North Dakota is the exception. They could have a law letting any tenant live in a place they never pay the mortgage for decades, and it wouldn't matter because their economy is going so well. So it doesn't matter what you do in Montana and North Dakota. Everything works there, okay? So you have to almost ignore them because they're just such an energy. They're a pure energy play. Kansas is pretty healthy. Midwest, ag again, schools and ag and so on and so forth. They're doing okay. No big cities there and so on and so forth. All right, so you're doing well here as well. There's no real problem. Here are some foreclosures. They vary and vacillate. And, places where no one lives, of course, have no defaults because there's no houses there. Where people live, there are higher default rates because places where they live, people buy houses in 04, 5, 6, and are underwater. That's just, but the magnitude of the underwaterness just isn't that large. So it's not going to take 20 million years to solve the problem. And even if it's a large amount of percentage terms, maybe they buy a house for 200 and now it's worth 170 or something. It's not such a debilitating amount of money that they don't see any hope or prospect of ever getting out from under this terrible burden. Unlike Phoenix, where they bought a house for 5 and it's now worth 2. That's a life-altering amount. That's a default decision. That's a pragmatic decision to default. Here you don't have that problem. You may have percentages of areas that aren't so great in foreclosure problems, but it's nothing even close to what's going on nationally. Unemployment rate. I mean, look at this. Just sit back and enjoy the ride, kids. You're almost living the dream here. You really are. I hate to paint such a rosy picture. I like to be depressing and doom and gloom. It's much more fun. It really is. This is painful for me to give you good news here, okay? I want you to know I'm suffering just like you are here. But this is a pretty good story. Unemployment rates, again, here's a geographic picture as opposed to a sequential picture. So look, you're doing well. You're doing well. The whole Midwest is doing okay. These states here, who cares what goes on here? These states, no one lives there. These have the virtue of no oneness. The whole population of these 5 or 6 states, if you include Kansas, is like, what, 9 people or something? I mean, there isn't even a city in any of these states that has 1 million people. I mean, Billings, 200,000, right? Laramie or Cheyenne. I mean, come on. Fargo? I mean, you're kidding me. The capital Pierre has 5,000 people in South Dakota. These are pipsqueak states. They're doing great. Move there. Yeah, there's no jobs because there's no, except for North Dakota. So things are good. Okay, going forward, let's see how severely things declined historically from the peak. And again, you're doing pretty well. There's not really bad news here. You're not here, the industrial heartland, where manufacturing really fell off a cliff at one point, and exports really took a hit, and Ford and the GM problems, Chrysler problems, really hit home hard. Nah, you look at the whole state here, it looks pretty decent. There's nothing terrible. There's pretty good news here and a little bit of badnish news here, but nothing really, look, come on. This is ground zero. That is ground zero. And these are, and here, there's some bad problems in Minneapolis, Chicago, and so on. But nothing really, really, really bad here in Iowa again. What's going to happen going forward? Iowa's a pretty good story. By the end of Q4, you have another year to go before we hit there roughly. I'll have to redo this number in a little bit future going forward. This is not a bad number. This is a pretty good story. That's a pretty good story. Things are okay. You're the top bunch here. This is good news. So I'll close on this note. The economy is improving. And while the improvement's uneven across all sectors, even here, housing was slower to the party than others. It's getting there. Things are getting good. We're not going to get back to where we were in 04 or 03 or 05 or 06, but we're getting there. On the macroeconomy, things are getting better. In so many areas of the macroeconomy, things are getting better. And on the household micro side, households are doing better. Balance sheets are improving, and we've cleaned up the mess. It's not surprising GDP growth has been slow over the last 3 or 4 years as this tremendous amount of tumultuous change has been taking place, and we've been readjusting and fixing our balance sheets, increasing savings, discharging debt, changing our spending patterns, and so on. Corporations have been getting lean and mean. This doesn't happen for free and takes time. But this hard lifting is now getting to be largely over, and housing now is going to take its place. And for the next 3 or 4 years, and then it will end, housing will go like this. And as it goes like this, it will create lots of jobs. Because every new house creates 5 jobs, 5, roughly. Nationally, 3 locally and 2 more nationally. So you add 200,000 jobs a year, 200,000 houses new, that's 1 million new jobs every year, 1 million new jobs. That will do a lot of good. So if the housing sector stays well and employment growth stays well, that's the fundamental most important thing. We may have a decline for a quarter or two. Things may not be great this quarter or two because of the sequestration, as I mentioned earlier. But they'll be okay. Oh, one more thought. We're still living off largesse, off central bankers. This is important to note, too. If they actually raised rates to where, they would be without the intervention of $1 trillion a year of quantitative easing and so on, interest rates would be higher, we'd be in much worse shape. So we're not quite there, but we're close. The fact that the Fed's talking about stopping QE and some of the Board of Governors people are talking about it says that the economy's almost there. It's getting there. QE presents some problems of unwinding. We can talk about that during Q&A if we have time. I'm not sure how much time we've got left. This is my last slide. How to reach me. If you want to call me up, talk about something, do it by all means. This is my cell number, my cell phone. Don't call me now and be a smartass. This is my email address, Elliot@graphsandlaughs.net. Used to be doomandgloom.com, but I changed because things are getting better. I'm joking. That's how to email me. You want to get a hold of me. Please don't email me like what the interest rate's going to do tomorrow. I don't know. I'll tell you they fluctuate or something, Now, lastly, I put out a daily 70-word blog on the economy. It's literally 70 words, never more. No graphs, no charts, no links, no photos, just 70 words on whatever I feel like about government, policy, economy, demographics, politics, game theory, foreign affairs, 70 words. If you want to get it, you can email me, but preferably give me your business card. Come up here and put it down the table here in this front table right here. Give it to me. I'll add it to my blog. You'll hear from me every godforsaken day. You have been an outstanding audience. I hope I haven't overwhelmed you with information. But the point here is things are better. They're better across the board, and there's been particular improvement of late in the housing market. And this improvement has retarded our improvement in GDP, but we're starting like a racing horse getting ready to get into the starting gate. We're not there yet, but used to be we were in the paddock for like 4 years, and now we're trotting from the paddock, into the starting gate. And they're going to pull the bell, and we're going to race out. It may not be for the year, but we're getting close. So if you have a business, congratulate yourself for having survived so far. If you have a business, make sure to see Steve and buy a farm, because that's the most important thing to do, right? farms, most important thing. If you have a business, think about expanding a little bit. Don't remain in the shell you've been in for the last 4 years of survival mode. Say to yourself, it's time to get better. It's time to do something different. Take a chance, hire a person, buy a piece of machinery, change your business model, look for something new. Look for a new niche you haven't exploited. Because of the improvement in the economy, it's much more likely to be successful. Don't bet the farm, but bet a little bit. Take a bit of risk. Because in an improving economy, risk will be rewarded. The risk opportunities now are there. Now, I can't tell you where to look, but you know, you're smart people, you've survived. And you're living in a good place. So if you make a mistake, you're much more forgiving here than other parts of the economy. Again, give me your cards. I'll be around for a while. It's been great. Thank you, thank you, thank you.
Thank you very much, Elliot. How about, I think we got time for 2 questions. Anybody have a question while we're...
2 questions. We'll auction them off.
Yeah.
The highest payer will get the questions. If it's a really dumb question, I'll ridicule you. No, I won't. I'm kidding. There are no dumb questions.
Yes,
You got
sir.
One.
Your blog this morning talked about 20,000 new jobs per month in the construction industry. Does that reflect for Iowa that has not had fluctuation, or is that mostly those other growing states?
The question is, I'll repeat the question for him. The question was, he had in his blog this morning, there were 20,000 new growth. Is that reflected in Iowa, which has been pretty steady?
Less so. You will benefit. Your construction collapse wasn't nearly as profound, so your improvement won't be nearly as dramatic compared to Nevada or California, Sacramento, and Miami, and so on. But you will also benefit from it, but less so than the national average because you suffered less.
Okay. Next
more
question.
question.
One more question?
I've answered them all. I feel thank you. Wow, this is very kind.
Oh, we got one more.
Oh,
she's
too
brave.
Bad. Too bad. Same table. I want to hear from other people.
At the beginning of your talk, you alluded to the impact of student loans.
Yeah.
Some of that.
Mm-hmm.
Can you circle back around?
Wow.
She
do
wants
I
to
have
circle back around student loans to give the
All right,
impact
student
of
loans.
that.
Student loans are a real hanging problem. Hey, you're back. Nice to see you. Dorrance has returned. You have to pay your student loans off, right? Yeah. Okay, so the issue with student loans is as follows. The accumulated total student debt out there has now crossed $1 trillion. It's bigger than credit card debt. And it's going to retard these people's ability to enter into the consumption mode. And we're Americans, and we spend, man. We're Americans. We're not Orientals. We don't save anything. We outsource savings to them. We shouldn't, but we do. It's a real problem. But that's something else. So this will retard their leaving their parents' household. They'll boomerang back to home. Not all, but a higher percentage. It'll take them longer to buy a car because they won't have a free cash flow to buy the car when they're paying $200-300 a month or $400 a month on their loans. It'll take them that much longer to buy a house. So this younger generation coming up will be essentially retarded in their access to capital, and they'll be able to borrow more money, and banks will say maybe not. Your income hasn't been so great because income growth isn't so good, and the total amount of debt you have is relatively high. So it'll make it more difficult. Fewer of them on an annual basis will buy a car. Fewer of them will buy a house or rent an apartment or get out and form a household. Household formations will be a little bit retarded. Will it be the end of the world? No. But it's a consistent headwind that we will be facing. And eventually, as this problem gets more severe, there will be calls to forgive all the debt. Because the whole generation of kids will grow up and they'll be in their 30s in 10 years, or 40s in 10 years. They'll say, hey, government, let it go. Give us a break. See, if you give us a break, we'll spend and buy cars and houses, and that will be good, right? So there'll be pressure politically to forgive the debt. And that will be an interesting drama to watch as it unfolds. But until then, certainly, I don't think that's a good idea. Well, we can argue about that's an argument we can have later. But we know in the short run this will delay all the life-changing events, marriage, and all these things will be pushed off because of this big bag of debt that they've got on their shoulders.
How about one more hand for Elliot Eisenberg? Thank you very much, Elliot. Well done. Thank you.